Welcome, everybody, to SuperCritical, the podcast that makes deep tech simple. Today, we're joined by Joe Wilson, founder and managing partner at Undeterred Capital, an early-stage venture firm focused on biological platforms and applied robotics. Joe has backed some of the most ambitious companies in these domains, including the likes of Parallel Bio and Shinkei. Before starting Undeterred, Joe was a co-founder of Multiply Labs, a YC-backed startup operating at the intersection of bioscience and robotics. Such an exciting journey that we'll dive into shortly. Joe, welcome to the show.
Thanks so much for having me.
Such a pleasure. So to dive right in, you are someone who was an operator, a successful one to it, but you made the jump to the investor side. What moment or realization made you trade the operator's desk for the investor seat? And more specifically, was there something you could do as an investor that you couldn't do as an operator or mentor?
Yeah, I don't know if there was any single moment. It wasn't like I left the operating side and immediately kind of went into investing. I think there was a period of, I don't know, maybe a year where after I left Multiply Labs, and this was late 2018, where I thought, okay, I'm going to join another company or start something new, and took a position at an early stage venture firm, really to figure out kind of what I wanted to build next. And it was during that year where I got kind of pulled into venture. And so for me, it was kind of bit by bit, understanding what happened behind the scenes of venture. Of course, though, working with companies I love, like everyone loves that part of it. But I think I really enjoyed some of the more boring day-to-day activities on the venture side. And I think just the way that I interacted with companies, it felt like I had a certain skill for. And so the deeper I kind of dug in, the more it seemed to align with my skill set, even better than when I was an operator. And by mid 2020, I thought, hey, I think I want to give this a go and start my own firm.
That is so fascinating. And as mentioned earlier, you focus mainly on those biological platforms and applied robotic solutions. So, outside of being uniquely positioned to invest in them, given your background at Multiply Labs, was there something you saw during that time that convinced you that these areas specifically are the ones that you'd like to spend, your career as an investor and capital from your LPs?
Yeah, when I thought about what to focus on as a firm, there were a number of areas that I was interested in, that I had vetted companies in, that I had kind of mentored companies in. But robotics and bio were two areas that I thought were really primed for explosive growth over the next couple of decades. I thought there were some structural things happening in both industries that would be major tailwinds in the years to come. And so both of those seem like really good fits and areas that I wanted to position myself in early.
So many companies have developed general purpose robotics platforms or the whole wave of AI-driven discovery. What, in your mind, is the difference between something that is truly a breakthrough in one of these fields and just a passing fad that really will not, dramatically change the outcomes?
Yeah, I think the most important thing is really staying tethered to reality and what is actually happening on the ground. So we do a lot of customer discovery work, a lot of talking with people who are using these robotic systems or people that could potentially use these biological platforms, these tools that are being developed, and understanding where their needs are and whether or not some of what's being built could actually address their needs. I think the biggest risk, or one of the biggest risks in deep tech, is spending years heads down building something that, by some definition is a technical breakthrough, but then realizing that customers don't actually care about it. And so I think that is one thing that we push our founders to really hone in on, is what's the problem being solved here. I think there could, just because it's a fad doesn't mean it's wrong. I think that's often, yes, they are fads, things fade into the background, but that's also where a lot of energy often is in the sector, and talent often flows to areas that are hot or seen as fads. And so our job, I think, is deciphering whether or not there's a there there and whether or not that fad can turn into something real, and that from there can emerge like a really big company.
Is there any story, let's say, call it like since starting Undeterred, that really underlines this process of like, discerning fad from reality, as you say?
Yeah, I think, one area, I mean, anything that touches AI, obviously we have to be a little bit careful. I think in biology specifically, um, the last 3 or 4 years especially, it's gotten very hot in terms of using AI for things like drug discovery, identifying new drugs and then taking them into clinic. It doesn't really work yet. Like there's definitely some interesting progress being made, some interesting applications that are emerging. But I think if you would have just bet on full AI, kind of a ChatGPT moment in biology emerging a few years ago, probably wouldn't be in a great position today, because I think it is a really difficult problem. Definitely progress being made, but that is a decade or multi-decade march to get to what is seen as kind of the holy grail in that industry. So that's one area of AI and bio. There have been kind of pockets of fad. And I think what's interesting is in bio, this is not the first time there's been an AI for bio wave. This is, if you talk to people who've been in the industry for 20, 30, 40 years, this is probably the fourth wave. And so again, it's like just understanding what's different this time, what's different today, and what could be different 5 or 10 years from now.
Is it just the optimism behind these new technologies, and how do you yourself avoid from falling into maybe these traps of where belief exceeds reality?
You know, I think I'm going to sound like a broken record here, but we take it back to the customer. I think like uh, one of the things we do is we say in an early pitch, like, let's assume everything this entrepreneur is saying in terms of what they're able to achieve technically. Do people care about it? Do customers care about it? Do they have the relationships with customers already? Do they know how they're going to enter the market and build those relationships? It's very rare where you have some sort of breakthrough and then customers just flock to you. Like very often, and we've had, multiple companies in our portfolio that said, we finally achieved X, kind of expecting a parade or something. And instead it's like, that's amazing. Now you have to do the hard work of building that customer pipeline, engaging with them, selling to them, which can be, a multi-year process. So that's what we always kind of take it back to, and how we avoid some of the post-breakthrough hype.
To you, what does it mean to have conviction, contrarian conviction in the fields that you operate in and you invest in?
We just think about it as seeing things really clearly. I think that's like, because it's really easy to be pulled into a hot round or, be offered the final allocation with tier one multi-stage firm. That's exciting. And you can kind of see, oh, wow, like with this backing and this team, they can do great things. We always just take it back to like, what do we see as the reality of the situation? And that means we end up passing on hot deals. And it also means we end up investing in deals that people are like, I can't imagine investing in that company. And normally it is some unconventional insight or some non-obvious insight that the founders have achieved. It's digging past superficial reasons that people pass. I think you'd be surprised the number of people who pass because someone's first language isn't English and they're kind of struggling with the pitch, or it's their first time pitching to VCs and the deck is terrible. And I think like we have to look past those biases on our side too. I think the other thing that we have to do is, we've looked at specific industries before. I mean, everybody has kind of their founder profile, and we're no different. We certainly prefer kind of the scientist or engineer, CEO, founder. That is certainly like our archetype. But, there are situations where we've looked at an industry, we've kind of said, none of these scientist entrepreneurs have succeeded in this industry. Maybe that's not the right archetype, even though that's where we came from in the first place. So we have to think creatively about, maybe it's a founder with a business development background who can really unlock what's been missing in this industry.
Is there an investment that comes to mind where you exercise that clarity of judgment?
Yeah, I think Shinkei is a good example. Shinkei is, an investment from our first fund. We invested in their pre-seed round. Safe, the CEO, is incredible. And what Shinkei does is they've created a robotic system to improve fish processing methods, to do it in a way that preserves the quality of the fish, which leads to higher selling prices via this automation of a process called Incubation, which is how sushi or cotton killed. I met Shinkei in Safe in 2022, who was not certainly wasn't a hot round then. I think what was really special about Safe is he had like a very well articulated strategy and plan for scale up for the company. He was really ambitious. He was also spiky in a number of different areas. So he was an incredible engineer. He was a really talented designer. I just thought he was really unique. And the rule that Shinkei broke for us is it's very rare for us to invest in a first time robotics founder who's under the age of, say, 25. And the reason is because in robotics, a lot of young founders like to build for novelty. And in robotics, value is not a derivative of novelty. Value is a derivative of reliability. And so it is very common for young robotics founders to build robotics that's never been built before, but that actually isn't reliable, and then customers don't buy it, and then you end up in kind of this tailspin. But I thought Safe was special enough, and I thought the market was big enough, if they were correct, where this could be a really impactful company. So we invested in their pre-seed in 2022. They've since, announced a couple additional raises. I think they've raised about 30 million since then. Founders Fund led their A last year, so they're on a good trajectory.
Absolutely. And I'd like to chat about another one of your portfolio companies, Parallel Bio, for a minute, which also recently raised their Series A. So congrats for that fantastic milestone. I think in a recent comment, you said that the founders have the same vision now that they had when you first met them, I think 2021. But then all this looked like a dream. What made that dream come true today? And what do you think they do exceptionally well? And what is the type of spikiness that they have that allowed them to thrive in such a complex industry?
Yeah, I think I actually think they share some feature with us, which is they see things very clearly. They see very close to their customers. You won't find them at, industry happy hours or, kind of trying to understand what the latest AI trend is. They're very, very focused on building customer relationships. What do they need? How does their organoid platform help support the main goals of the customers? They came from really strong technical backgrounds. They built similar systems before. So I think they knew what they needed to build. They knew the customers that they had to engage with. It was really a matter of execution and staying true to the vision. I think when we invested, organoids were not a new thing. They had been tried for a couple additional cycles, and they hadn't really worked. They hadn't worked at scale. They weren't able to scale up. The data that was being generated from them wasn't that good. And their hypothesis was that was very fixable. And it was really a matter of demonstrating that at a lab scale and then scaling up. So they were able to stay true to that vision. Now they're certainly in full scale up mode. And I think we've been fortunate that the regulatory tailwinds have shifted a bit too. So in organoids, a lot of the purpose of these organoids is to either augment or replace animal trials in some way by simulating interactions of drugs in these humanoids. And from that, you can get data on the safety of these drug candidates, on their efficacy. And over the last year or so, the FDA has really shifted to push for more and more of these organoid systems being used in lieu of animal trials. So that was not something that, we necessarily counted on when we invested in Parallel Bio, but it certainly has turned into a big tailwind for them.
Beautiful. And, we spoke about two companies that are really clear examples of your thesis, but, you live in two different worlds, the world of applied robotics and the world of bio. Do you have any, let's call it, quick cognitive frameworks that you rely on to assess opportunities in each, let's say with fast and I wonder if there's any traits that maybe are critical for success in one that become either irrelevant or even counterproductive in the other.
Yeah. I think the commonality across both. Well, the first thing I'd say is we're very careful about the types of bio companies and the types of robotics companies we invest in. We don't do everything across those categories. What we're looking for is there, our value add is providing operational support, is helping companies with that initial go-to-market, that initial commercialization, customer building, kind of burning down the business risks of the company before they go to market and as they're going to market. There are bio companies where that's not really relevant, and those normally aren't great fits for us. But what we see across those categories, across these companies, is that's often why these companies fail. It's not because they're not able to achieve some scientific or technical milestone. It's because they're not able to translate that into what customers actually need. So that's the gap in the market that we see. That's where we plug in, and that's where founders leverage us as well. I think this is normally true across bio and robotics. I would say the impetus of, I think in bio, there are just certain milestones you have to hit from a scientific perspective to demonstrate your process works, to demonstrate your platform works. You can't really get around those. You can pivot the platform and do something else, but you do have to hit those if you're going to deploy it at scale. Robotics, there's a lot of different ways around it. It's why I'm a bit skeptical of any strategy in robotics that relies upon intellectual property. It's just, that's normally not why companies win in robotics, where it could be in the case of bio. And so in robotics, it's really about how do we get to reliability? How do we replace novelty with reliability? How do we simplify things again and again and again? And that's not always true in the early days of biology.
I was thinking something about regulation and regulatory complexity really kills companies. Is there a company that you think, almost died from it, but actually managed to survive and tell the story? Either in your portfolio or in your network.
So I think there's maybe two buckets of regulatory risk. I think the first bucket is kind of the standard regulatory risk. For instance, if you had a diagnostic device to detect early stage cancer and you're taking that to market, of course, you need to get approval. That's kind of normal regulatory risk. Abnormal regulatory risk is if you're introducing a new paradigm to the market and you don't know exactly what the regulatory approval process is, or you're relying on something that isn't done frequently. That is in kind of the abnormal bucket. We normally don't bet on the abnormal bucket. That is normally out of scope for us because typically it's a very bespoke process. It ends up taking way more capital, and it's difficult for downstream investors to stomach as well. I would say we have made investments in robotics companies that have a little bit of that abnormal risk if we can quantify it to some degree. We invested in a company last year called Newlight. And what Newlight does is they have a device that injects hydrogen directly into ships, into kind of their fuel tankers, and dramatically increases the efficiency of those ships, which is amazing. It's fantastic technology. And they required approval from different commissions to install what is literally kind of a robotic injection device onto these ships. That was a pretty opaque process. We didn't know other companies that had gone through that. That required more underwriting on our side to really understand what was required to get that approval, what the blockers would be, and what happened if they didn't get it. So we took a little bit of risk there. I think we got comfortable with it. It wasn't too cumbersome of a process. The company actually announced last week that they received this approval about 6 months before they were expecting it. So, in that case, it looks like we kind of bet correctly, at least at the first stage of this. But it is something we think really deeply about. That is not what we don't want companies to die because of abnormal regulatory risks. That's entirely preventable.
That is a, perfect segue into, is there an example maybe of a deal that you either seen or kind of made happen because of research that allowed you maybe to identify a opportunity that was kind of under the radar?
Yeah, absolutely. I mean, so first of all, on the research side, it's important to call out Emily from our team runs our Undeterred research group, has done a phenomenal job the last 2 years, and I think has really just built it into a repository of really deep insights in a variety of industries. Kylie recently joined our team a few months ago after getting her PhD from USC. She has been an incredible asset as well, and they really kind of run the the research side of the house. I think for undeterred research, our thesis is always understanding or really kind of identifying industries that are either we're seeing more companies in that space. We've seen them in the news. We've seen them talked about from professors, just things that are a little bit under the radar, and then really going deep in these niche categories and publishing what we find about them. And that's everything from biological advances in agriculture to maintenance robotic systems to kind of bespoke regulatory processes. And we go deep. I think what we're trying to hit is we need to make them understandable enough by a general audience where, maybe if you or I was reading in an area that we didn't know much about beforehand, we could understand maybe 80%, but we also want to make them deep enough where people who are operating in the space are able to pull out, 2 or 3 key insights that maybe they didn't know before. And so I think that's what we try to hit with each of our research reports. I think it's really given us a prepared mind for looking at a lot of companies. I think it's introduced new frameworks. I think one in particular that we use all the time now is often these research reports will lead to dead ends, so to speak, in industries. We'll discover, okay, maybe this industry isn't so great because it's got X and Y and Z blockers that are going to prevent companies. So what that's pushed us to start doing is, okay, but what's an example? What would a company need to look like in this space for us to make an investment? And that kind of tests our hypothesis in terms of how we think about valuation, in terms of how we think of founder profile, in terms of how we think of scale-up plan. And that's led to a number of new investments. So yeah, I think the other aspect of these reports is it's pushed a lot of inbound our way from entrepreneurs who see that we know these areas well, we're interested in them, and who reach out to us to see if we could be a fit as partners.
Mm-hmm. Is there a way for you guys to pick a deep dive area over another? Like, do you have a quick framework, or is it just like, all right, how big is this problem in terms of $1 billion spent, and that's how we're going to attack it? Or what's that quick razor to decide?
Yeah, so at the beginning of each quarter, the research team and I, Emily, Kylie, and I kind of put our heads together and say, what's interesting to us? That's normally what starts the conversation. We all come to the table with different ideas on what could be compelling. I think one thing we try to write about what's not being written about today. I think that's a big part of it is we don't want to publish, the 10th report on a particular subject that's already been well covered. Our very first report in the summer of 23 was on nuances of AI in biology. And we hadn't seen anything like that in the wild yet. Now there have been, 1,000 reports on that subject. So we do look for areas that aren't well covered, and even if they feel very niche. And so that is our first principle there. The second is just what is interesting. We spend 3 months writing each report. It has to be interesting enough where it's going to keep our attention during that time. And the third that we think about is will writing this report help pull in entrepreneurs to our orbit? Is this interesting enough where it's going to engage the people in this sector to engage more deeply?
Mm-hmm. I guess quick question. This is maybe an aside, but what do you think about incubation? Like, isn't operating this early and kind of having an opinion on what a company looks like to win in those fields. Other firms kind of have that approach. Like, we have an opinion on the space. We'll look for the operators to build the companies that we think will win. What's your take on that? On that?
Yeah. So first of all, I think is defining incubation. I think the most traditional incubation definition is you have the idea, you recruit the team, you bring the team in, you give them capital, you scale them up. I'm skeptical of that approach. I think it can work if you're a firm that has plenty of capital and plenty of time. When we think about incubations, they're more like inception stage bets. Like what we don't do, like we're not recruiting professional CEOs to our companies to run them. It has to be a founder-driven problem. Now, we've had 4, 5 situations where we've helped build the company from the outset with the entrepreneur, where we've said, this is a really interesting idea that you've come up with. We'll be your first capital. We'll help you build this. We've had some success with that method. But I think the method where the venture firm is coming up with the idea, I feel like it rarely works. And so when I say incubation on our side, it's almost always We're providing the initial capital. We're helping the entrepreneur build the company, but it is the entrepreneur's company.
Mhm. So they might even come to you and say, all right, Joe, fantastic piece. I agree on these premises. On these, maybe I can challenge you. And you're like, great. Then it's more of a partnership truly at that point with the founder rather than being you the keeper
And
of truth.
we have certainly ideas that we think entrepreneurs should pursue. And so if we meet a talented entrepreneur that's operating in them, there's a lot of going back and forth, refining the idea. And often we're there with the first capital if they decide to start it as a company and scaling up. But I think what can't really be replaced, especially repeatedly, is being the one who has the idea and kind of replacing the role of the founder. I think
Mhm.
that's just really tough to do.
Yeah. Do you believe the prepared mind approach is the best way to win an early stage venture?
Uh, I think it's dangerous. Our team loves to read. We love to do research. We love to dig in on these specific areas. And so in that way, sure, we do have a prepared mind, but I think it's really easy to slip into traps there. I think, especially, I mean, there are industries that are out of favor right now. So for instance, in our world, biomanufacturing is a tough space to build a company in. And so I think it's really easy to say there's a lot of structural reasons why biomanufacturing is not like a venture scale area anymore. I'm just going to like ignore this category or come in with like very high skepticism about any company. But the other side of that is entrepreneurs aren't dumb. They realize what the blockers are in the industries, and many are designing ways to build companies in very different ways. And so if you meet the right entrepreneur who is building in that way, you may have an opportunity to invest in kind of the next wave of biomanufacturing companies once all some of these like structural issues are solved. So I love the idea of the prepared mind in terms of like being well read on a particular subject. But you have to be really flexible when you're meeting with such an early stage companies, not to pattern match and pass too early.
Do you think there are any, call it subtle founder behaviors that you've learned to trust, even if maybe they're minor or secondary at first, that maybe actually are signals for something that, that they're the right founder?
Yeah, I think the conventional wisdom at the pre-seed especially is financial models offer virtually no value. And I agree to the extent that like it's not a highly accurate plan that you should follow, but we have found a correlation between like our founders that are best performing and the ones that have the best understanding of their business at an early stage. Often the way you get a good understanding of your business is you model it out, is you understand what the different levers of your business are, you understand what your vulnerabilities are, you understand what strengths or opportunities they are by building something that looks like a financial model or something that really kind of crystallizes what your assumptions are. And so, it's silly in some ways. We're talking about technological breakthroughs, why does, modeling out cash flow for 10 years matter? But I think it really demonstrates forward thinking. It demonstrates that entrepreneurs are interested in building a business, not just a technology. So that has been almost a counterintuitive thing from some of the best founders we backed.
Hmm. Is there a trait or behavior that is instead overrated or overhyped that you actually might backfire in the long term?
Yeah. Um, I think it's really appealing for deep tech founders to pursue technology in a vacuum. I think maybe the manifestation of that is there are a lot of founders who want to build factories. And I get it. I've built a factory. It's like, it is cool to like have a physical structure that is yours, that you're running the company through. I think it's really dangerous if it's not totally critical to your company. I think in a lot of cases, it's founders convince themselves it's a need to have, and it's more like a very nice to have. It ends up being a major distraction for the company. You have to devote a ton of time and energy. And in terms of future capital raises, it's seen as more a liability than it is as an asset.
Hmm.
And so that is one thing I'm cautious about encouraging founders to do. And more often than not, it's a negative indicator. The exceptions kind of make the rule. There are fantastic companies that have built factories at scale and are doing great work today. But in each of those cases, it was totally critical to what they were doing. They could not have built the company without building these factories. And so I think that's like one of the easiest things to slip into is deciding we want to build a factory because our process will fit in a factory. It is very rarely a requirement.
Looking into is that like understanding what is truly critical to your business. I think there's the challenges that these companies face don't stay still from an operational point of view, but they do evolve as they grow. So do you think what have you seen work that works really well maybe at pre-seed, but then breaks later on? Is there a great founder, a great story that you know of someone who's actually been able to adapt to those challenges, to those, mission critical items and how they evolved over time?
Yeah, I think every founder has to adapt kind of post Series A or during the scale up. I think that's inevitable. I think what works at the early stage in terms of driving process, in terms of having your hand on the wheel, it becomes harder and harder as you scale. And that almost always comes in the form of hiring and building a team. I think that's one really critical thing. I think as well, when you're scaling up, you have to move from building an N of one system to building a system that's easier to assemble, that's cheaper, that's more reliable. That doesn't always require the same team. Often you need to have kind of your core research team, and then you need to have a scale up team as well. And so those are some of the things that companies have to do. I mean, coming back to Parallel Bio, I think they've done a really good job of this. I think for a long time, it was just the founders, Rob and Juliana, who were building out their company, who were doing all of their sales, who were building and de-risking the tech. They did everything themselves. And I think over the last year and a half, its demand has skyrocketed. They've done an excellent job hiring an executive team, offloading some of those responsibilities, and they've been able to focus on a lot of kind of the technological scale up side, but have also brought in a great CTO to help with that. So I think like there's almost a refounding moment once you're ready. Once you know you've got demand out there, once the tech works, to really start ramping things up. I think that's true for any company we've seen in the portfolio.
Does Series A to you still mean end of technical risk and start of commercialization? Or is that, let's say, I won't call it general rule, but like kind of assumption in many investors' minds. Is that still true for you today? Does that ring true?
No, I think, it's funny. When I was building my company, there were plenty of robotics companies that didn't start commercialization until like after the Series B even. It was a lot of kind of focus on the upfront technical risk. That model has largely faded. Most of what we see now, I mean, I would say 80 to 90% of the companies that we back are in the commercialization process already or will be within a year. Like they're at the pre-seed, they're already there. And the reality is there just isn't a lot of excuse not to launch quicker. If you're still 5 years away from commercialization, unless you're working on something that just has a really long technical lead time, you should have it in front of customers. You should be testing it with customers. If you have robotics that's not reliable, that's fine. But you can still be piloting with customers. You can still be collecting feedback, getting early revenue. So we've seen robotics companies at the pre-seed that are doing 6 or 7 figures of revenue and growing really fast. I think just structurally that has changed. So I think the paradigm of pre-Series A, focus on the tech, post-Series A, focus on commercialization, we don't see that much anymore. In most cases, the founders, by the time they're at the A, they're ready for scale up. They're ready. They're at $1 million or $2 million or $5 million in revenue. And it's how do we get to 50? How do we get to $100 million in annual revenue?
Can you think of a founder who's found a creative way to, structure commercialization that surprised you? And, what's the weirdest GTM hack that you've seen work at deep tech so far?
Yeah, I think so. I don't think I mentioned the company name, but there's one of our founders in the bio space. I think the common knowledge in bio is it takes contracts a really long time to get done. And I think the conventional wisdom as well is you should sell it to the executive level. You'll have buy-in. That means bigger contracts. Yes, it takes longer, but it's something you just have to kind of chip away at. And many of our companies have followed that approach, and that's resulted in big contracts. What this founder realized was they sell a specific device. He thought of it as like, what is the number that no one could say no to if they agreed that the product was critical. And that number was in the five-digit range of how much they're selling. What this allowed them to do was enter at a lower level, sell to individual departments as opposed to selling to the parent co, the larger pharma or biotech company. Then he was able to implement a land and expand strategy where he was selling to a number of these departments across pharma rather than rolling it up to an overall deal. And that has allowed him to just scale up much quicker. The approval process takes weeks as opposed to months or years, and the revenue can just compound. And in the meantime, they're building a reputation within a number of these companies. And he's implemented this across a number of pharma companies on fire at this point. It's just like, it's not an easy thing to implement. It really relies on a lot of connections to some of these department level groups, but it's been really effective and it's been different than what I've seen in most cases. I will say, I think a lot of the more clever hacks like don't work. We refer to a lot of those as bank shot approaches, where a company is pursuing a smaller initial market and says, we'll pursue this market, and then when we're successful, we'll kind of bank off it and then go to a bigger market that's in a totally different space. Those are rarely successful. And the reason is it's normally not easy to win in that initial market. I think a lot of founders see an initial market and say, it's small, it's got lower barriers to entry, I'll just enter there, dominate that, and then move to other areas. That area is normally pretty tough to compete in because it's an efficient market, and there are people who just care about that market that you're competing against. And so founders get stuck, and then they get stuck in an initial market. They never move to the subsequent market, or they discover that the team they've built to be successful in the initial market is totally different than the subsequent market they would move into, and they end up kind of stuck in this. And so I think like clever methods to get in front of your target customer, I'm all for. I think like clever go-to-markets that involve like multiple miracles occurring for you to be successful, those I'm less enthused by.
I think it goes back to what you were saying earlier. The founders have a real clear sense of the path that they need to, go through to get to, scaling within that market, and know very well what levers to pull. Those are the ones that tend to be more successful.
Yeah, and it's not an easy decision. Like often it's not entrepreneur. Our phrase that we remind ourselves is like, these people are the smartest people in the world. Like they get it. But often the challenge is entrepreneurs are forced to choose between a market that's readily accessible, but one that is not their target long-term market, or a market that is not accessible at all and is their long-term market and will require much more cash and time to get to. And that is therefore like riskier on the commercialization side. And for a lot of first-time founders, that is a way more treacherous path. You could get halfway through, realize you don't have enough capital, realize the market is still not open, and you'll have other investors chirping in your ear telling you to pursue this short-term market instead. And so founders get stuck between these two worlds and don't know which one to pick. So I don't want to make it seem like, oh, it's like a dumb mistake that founders make. Most kind of think about it for years trying to understand the nuances of it, but it is like one of the most pernicious traps in deep tech.
What role does investor play, or investors, the early investor play in helping the founder, make that decision?
So our philosophy when we work with founders is we like to be, and we're willing to be as involved as you want it to be, but it's your company. Like you're steering the ship, you're making the decisions. Founders decide on the cadence we meet with them. Founders decide how they engage us, and founders make the strategic decisions. Like my insights from, talking to you for half an hour every other week are not the same as you who've thought about this problem for 300 hours. Like that, I can offer anecdotes and things that have worked with other companies, but like it's not the same. And so I think you want investors that can go on that journey with you. But then when you've made the decision to support the scale up, I think like when founders make decisions that we disagree with, it's it's a commit and get on board. But, we also we're not kind of pacifist in this way. Like we're willing to say, hey, just so you know, these are going to be the trade-offs now, these will be the trade-offs later. So I think for founders, it's about having an active thought partner, but also one that's not going to be difficult if you make a decision for the company.
Looking back, over the last decade. Is there a single decision, whether as a founder or an investor, that scared you at the time but ended up shaping your path more than anything else?
Yeah. So, I mean, this was when I was first starting the firm back in mid 2020. I started raising capital fall of 2020. And I remember I was having a conversation with the managing partner of Loft Capital and the founder, Peter Erbert. And, and Peter, we didn't know each other that well at the time. And I told him that I was starting this fund. I said I had, I don't know, $500,000 committed or some very small number. And I was trying to hit 2 million before I did my first close. And what Peter said is that's a terrible idea. You should just close right now. Like just close your initial capital right now. Do 100 closes if you have to. But right now you are nothing. After you do this close, you'll be a venture capitalist. And he was right, especially for me. I didn't have a track record before. I came purely from the operating side. The most important thing was having momentum and making those initial investments. And so did the first close. We made our first few investments. As they started doing well, we were able to close a little bit more capital, and it just kind of rolled from there. I don't know if the firm would have existed if we would have waited till we raised 2 million. I think, even in those frothy days of 2021, it was still tough for an early stage investor who didn't have a track record to raise capital. So I think that was the most important early decision I made.
Very brave. What role do mentors play in your role as a GP, and how does it shape your investment thesis, your approach to the job, and has the relationship to the job and the role changed over time?
Yeah, I think I've been fortunate to have a number of great mentors. I often love hearing about just how things go wrong, how things fail. I think there's a great podcast I listened to maybe 5 years ago. It was the former chief strategy officer of Microsoft talking about the kind of the path that a lot of entrepreneurs walk. And, what he was saying is, a lot of entrepreneurs look at SpaceX, they look at Google, and they say, how do I be like those companies? How do I be the best performing company in my space? When in fact, if you look at like the funnel of companies, to get into the top decile, you just have to survive, right? And so I think his point was it's more important in the early stages to really understand why why companies are most likely to die, rather than understand why they are going to succeed. And so in my early stage of building a venture firm, this is especially true when you're building a venture firm. Like, I think it's something like 60 or 70% of venture firms never close their first fund. They start it doesn't go anywhere, and then that's it. And so if you can just get to a first close of your venture fund, you've already beaten 60% of the participants. And then the funnel becomes even tighter when you go venture funds that made it to a fund 2, and then venture firms that made it to a fund 3. And so understanding what the reasons for failing at each of those stages are, I think is just really, really important, rather than how do I build the next benchmark? How do I build the next Andreessen? That's less useful for someone who's like at the really early stages of firm building. A lot of my mentors have weighed in on that process, and it have helped me crystallize what I'm trying to build. Am I trying to build the next Andreessen? Am I trying to build the next benchmark? Am I trying to build the next IA Ventures? They're radically different paths. And that's how I've leaned on my mentor network.
Looking back at your journey, what responsibility do you think a VC has in shaping the future? And, how do you personally live up to that?
Venture capitalists are and should be in the backseat of the car. I think we're in the car, but we're not in the front seat. We shouldn't be in the front seat, and we certainly shouldn't be driving. And so I think it's really important to understand as VCs that we're not the main characters. I think that's really tough for a lot of VCs who like to be the main characters. And whether that shows up online or whether that shows up in the boardroom, that is rarely in the benefit of a company. And so I'm in a super fortunate position in that I get to work with entrepreneurs during their most vulnerable moments, when the company is on the line, where sometimes it's giving thoughtful advice, Sometimes it's just listening to them rant. Sometimes it's playing what they're saying back to them. Sometimes it's understanding, what they may be missing about a certain situation. That is such like a fortunate and lucky position to be in with some of the best entrepreneurs of this generation. So I take that really, really seriously. I think that has its own impact, and I think entrepreneurs know it has the impact, but it is a more muted impact than being an entrepreneur and driving the future forward in a very direct and tangible way.
Absolutely. Absolutely. This is truly inspiring. I'd love to close this session with maybe a quick fire round or lightning round with a few of our signature questions. So to start off, like, what does supercritical mean to you today?
Supercritical means something you can't live without. And I think it does align very well with our thesis when we're talking about customers, when we're talking about adding value to what they do every day, and technological breakthroughs. When they align with supercritical needs, that's how you create generational companies.
Is there a belief you hold now that will look obvious in 5 years but sounds kind of unreasonable today?
I think the robotic revolution is already here. People are talking about humanoids and what's going to happen in 10 and 15 years. I think if you're paying attention, it's already happening. It's just happening with robotics that don't look like the humanoids that are out there today, but it's already proliferating industries. It's going to be a sector that's equal or bigger in size than software. And I don't think that'll be much of a debate 5 or 10 years from now.
And what's the hardest truth you've learned about building or backing breakthrough technology?
I think no one really cares about the breakthrough. People care about it in an academic sense. People care about it in maybe a civilization sense, but investors rarely care about the breakthrough itself. It's what you do with the breakthrough.
And if you could whisper one piece of advice to your younger self, what would it be?
Know when to be patient and know when to push.
Great wisdom. Joe, thank you so much for your time today. Really appreciate it. Listeners, thank you for tuning in, and catch you next time.
Thanks so much.